Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Planet Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, imagine a company that takes a high-definition photograph of literally every single inch of the Earth's landmass.
Every single day.
Every single day. And for a decade, doing that meant, burning through cash like rocket fuel.
Oh, absolutely.
Yeah.
The capital required to just build, let alone launch and maintain a satellite constellation, it's staggering.
Right, it's astronomical. But today, that narrative is completely dead.
The hardware phase is over.
Exactly. The hardware phase is over, and the high-margin software phase has basically begun. So what we are analyzing today is a company undergoing this massive, really watershed transformation.
Yeah, moving into a highly profitable software as a service platform.
Right, a SaaS platform. So the mission for you today is to really dissect this recent, frankly violent upside re-rating of the stock. We're going to analyze their first ever profitability metrics and, really evaluate if this, a 400% rally since last summer?
Yeah, around 400%. It's massive.
Right, so we need to see if that still offers a compelling entry point for you, the wealth-building investor.
And to understand that underlying structural shift, we really have to look closely at the mechanics of their financial inflection point.
Right.
Because the immediate catalyst driving market sentiment recently was their fourth quarter fiscal year 2026 earnings report.
That was the big one.
Exactly. That was the moment the company basically proved their business model actually works at scale. I mean, in that fourth quarter, they reported record revenue of $86.8 million.
Wow. Which is...
It's a 41.1% increase year over year. And it just crushed Wall Street consensus expectations by roughly $8.7 million.
That's a huge beat. And if you zoom out to the full fiscal year 2026...
Revenue hit $307.7 million, which is a solid 26% year-over-year growth rate.
See, but here's the thing. If they are truly making that software as a service pivot, the proof has to be in the operating margins, right? Not just top-line revenue.
Oh, 100%.
Because in the aerospace and satellite sector, getting to actual profitability is traditionally the ultimate friction point.
Yeah, it's where most companies fail.
Exactly. You have to spend hundreds of millions upfront in capital expenditures just to establish the constellation. And for years, they'd just bleed money.
Right. Relying entirely on the hope that eventually the recurring revenue from selling the data will outpace the heavy fixed costs of keeping the fleet in orbit.
Right. And we are finally seeing that crossover point materialize. Because for the first time in the company's history, they achieved an annual adjusted EBITDA profit.
$15.5 million.
Right. But the far more crucial metric for evaluating their long-term viability is free cash flow, which turned positive at $52.9 million for the year.
Which is huge. That represents true cash-generative maturity.
Let's unpack that for a second. What does cash-generative maturity practically mean for their operational strategy?
Well, prior to this, a capital-intensive space company relies purely on external funding.
Right. They have to tap debt markets or issue secondary stock offerings.
Which dilutes existing shareholders, just to keep the servers running and the rockets launching. But generating $52 million in free cash means they are now completely self-sustaining.
They can fund their own R&D.
Exactly. They can fund their own research, development, expansion without needing a lifeline from Wall Street.
Which is an incredible place to be. And that independence is precisely why institutional money is suddenly taking a serious look at the stock.
Right. But we have to address the elephant in the room. Because a casual investor running a standard financial screen might be deeply confused right now.
Oh, you mean the net loss?
Yeah. Alongside that positive cash flow, the company reported a GAAP net loss of $246.9 million.
Right, which sounds terrible. On paper, a $250 million loss totally contradicts the whole narrative of a profitable turnaround.
Yeah, actually. So we need to give that GAAP net loss strict analytical context. Otherwise, it paints a completely distorted picture of their financial health.
Yeah, out of that $246.9 million loss, $161.4 million was entirely non-cash.
Entirely non-cash.
Right, it was driven by a warrant liability revaluation. And to understand why this happens, we have to look at how warrants actually function. They're essentially, long-term options given to early investors or partners.
Right, granting them the right to buy the stock at a specific predetermined price.
Exactly. So when the underlying stock experiences a massive surge like this one, just has the intrinsic value of those warrants skyrocket.
And accounting standards mandate that the issuing company has to record the increased value of those outstanding warrants as a liability on their balance sheet.
Right. So as the stock price goes up, the calculated liability increases, which then flows through the income statement as a non-cash expense.
It's honestly the ultimate high-quality problem.
Yeah, it really reminds me of like someone who wins a $100 million lottery, right? And then spends the whole week complaining about the $40 million tax bill.
That's a perfect way to put it. Yes, a massive liability shows up on the ledger, but it only exists because the underlying asset, the stock itself, performed exceptionally well.
Right. It does not drain a single penny from their bank accounts. It doesn't impact their daily operations at all. It reflects market confidence, not a fundamental operational flaw.
Exactly. And looking ahead, management guidance points to first quarter fiscal 2027 revenue between $87 and $91 million.
So continued sequential growth.
Yeah, implying continued growth. But here's the catch. Generating cash flow immediately puts a target on your back.
Oh, for sure.
If a well-funded aerospace startup sees a $52 million free cash flow yield, they're going to want a piece of that margin. So we have to evaluate what actively stops a competitor from just raising capital, launching their own constellation tomorrow, and undercutting them on price.
Right. What's stopping them from stealing their lunch? Let's analyze their defensive posture. Starting with their capital reserves, they're sitting on a fortress balance sheet.
$640.1 million in cash and equivalents.
Yeah, which completely insulates them from any near-term liquidity crises. But the real barrier to entry is their contracted backlog.
Right, what the industry calls remaining performance obligations.
And what is that backlog currently sitting at?
It stands at $900.4 million,
Wow.
which represents a 79% year-over-year increase.
So almost $1 billion in locked-in contracts?
The mechanics of that are vital to understand. $900 million provides roughly 3 full years of revenue visibility at their current run rate.
3 years. That's for an institutional investor. Visibility like that massively reduces the risk premium of the stock.
Absolutely. The company doesn't have to spend excessive capital aggressively hunting for new clients just to meet next year's baseline projections.
Because the sovereign governments and massive enterprise clients are already contractually obligated to pay for the data.
Exactly. Now, a significant driver of that backlog expansion is the defense sector.
Right, where revenue surged 50% year over year.
Yeah. And the prevailing narrative there is that sovereign governments are scrambling for space-based intelligence due to the ongoing, tragic conflicts in Ukraine and the Middle East.
Okay, but as an analyst, I have to challenge the sustainability of that growth for a second.
Sure.
If a massive chunk of this recent surge, that 50% is tied to current geopolitical flashpoints, might we just be looking at a cyclical defense bubble?
It's a fair question.
Like if and when those tensions cool down, don't we run the risk of demand for this intelligence plummeting, which could potentially crash the stock?
It's a very necessary risk to evaluate. However, when you actually analyze the specific nature of their recent agreements, it reveals a different structural reality.
Okay, how so?
Take their newly secured $240 million multi-year contract with Germany.
Right.
That agreement is for the development and utilization of a system of over 100 satellites.
Wow, 100.
Yeah, that is a foundational long-term infrastructure commitment. Sovereign nations are not purchasing this as a short-term tactical reaction to a localized conflict.
Ah, I see.
The realization across global defense ministries is that persistent, space-based intelligence is now a permanent layer of national security architecture. It completely transcends individual conflict cycles.
So that 50% surge isn't just a temporary spike in data consumption. It's governments literally permanently modernizing their intelligence grids.
Precisely. And beyond the defense sector, the company has insulated itself through immense commercial diversification.
Right. They do a lot in agriculture, don't they?
Huge in agriculture. They utilize multispectral imaging to measure crop yields, monitor soil health, and optimize irrigation at a continental scale.
That's incredible. And they do supply chain stuff too, right?
Yeah, tracking global supply chain bottlenecks by monitoring port activity. And they provide critical data for ESG and climate monitoring, like tracking deforestation and industrial emissions.
And all of those are permanent structural tailwinds that are entirely decoupled from defense budgets,
Exactly. But that diversification is only possible because of their physical moat. They operate the largest imaging satellite fleet globally.
which gives them that daily revisit capability we talked about.
Right. And to understand how that works physically, you have to look at their orbital dynamics. They have hundreds of small satellites deployed in a sun-synchronous orbit.
Okay.
So as the Earth rotates beneath them, these satellites act essentially like a massive continuous line scanner.
Oh, capturing an image of the entire global landmass every 24 hours.
Exactly. And no other commercial entity possesses the hardware infrastructure to refresh global data at that frequency.
And having a daily refresh rate creates this compounding advantage over time, which brings us to their historical archive. They've been scanning the globe daily for over a decade,
Right. They hold the world's largest commercial satellite imagery archive.
which is a massive moat. Think about it, if a European startup manages to raise billions of dollars and successfully launches a competing constellation tomorrow.
Sure, they can take a picture of a naval base or a wheat field today.
Right. But they absolutely cannot tell a sovereign government or a commodities trader what that specific location looked like last Tuesday.
Or last year or 5 years ago.
Exactly. Planet Labs owns the historical baseline.
They do, and this is but having a massive volume of data is a structural advantage, sure, but raw data is notoriously difficult for end users to monetize efficiently.
Oh, it's a huge pain.
Historically, a government agency or an agricultural conglomerate would purchase these raw satellite images, the pixels, from Planet Labs. Then the client would have to employ large teams of geospatial analysts to manually comb through the images.
Counting shipping containers at a port by hand.
Yeah, or looking for subtle discolorations in a forest canopy. It was an incredibly labor-intensive, high-friction process for the customer.
And the friction in that legacy model is precisely why their recent strategic partnership with Nvidia is, I think, the most critical variable in their long-term valuation.
Oh, without a doubt.
Because they are transitioning from selling raw pixels to selling real-time answers.
Right. But analyzing spatial data requires an entirely different computational approach than analyzing text or, standard financial data.
Because satellite imagery is multispectral. It captures data layers far beyond just the visible light spectrum.
Like near-infrared.
Right, which is crucial for determining chemical compositions or vegetation health. Processing those massive multi-layered data sets in real time requires insane parallel processing capabilities.
Which is exactly the architecture NVIDIA's graphics processing units are built for.
Exactly. By integrating NVIDIA's GPU-native artificial intelligence engines directly into their pipeline, Planet Labs fundamentally changes their product offering.
They are no longer just sending a high-resolution photograph to a client.
Right. They're sending a real-time automated data feed, something that immediately alerts a customer. Hey, there are exactly 42 supply trucks at this specific border crossing today, representing a 20% increase from a baseline established over the last 6 months.
It's game-changing.
It really is. It's like transitioning from selling a customer flour, sugar, and eggs to selling them a fully baked, decorated wedding cake.
That's a great analogy. And the secret mechanism here is that Planet Labs has a robotic chef, the AI, that has been studying every single recipe baked on Earth for the last 10 years.
Yes, because it has that historical baseline from their massive archive.
The AI doesn't even need to measure the ingredients anymore. It instantly recognizes the pattern, analyzes the multispectral layers, and spits out the exact answer the customer is looking for.
And selling the insight commands a massive premium over selling the raw commodity,
It reduces the customer's overhead by eliminating the need for human analysts.
while simultaneously transforming a low-margin hardware deliverable into a high-margin software product for Planet Labs.
Exactly. But remember, the AI is only as capable as the dataset it trains on.
Right.
And that decade-long historical archive provides an insurmountable training advantage. Any competitor attempting to build a rival geospatial AI simply lacks the historical imagery required to train their algorithms to recognize temporal patterns or seasonal anomalies accurately.
They just don't have the tape.
They don't. And to capture this expanding addressable market, Planet Labs is aggressively scaling their physical footprint, specifically targeting European defense budgets.
Ah, yes. They are currently recruiting up to 70 new employees to staff a newly established manufacturing facility in Berlin.
which is a highly calculated geopolitical maneuver.
Placing a major hub in Berlin, yeah, that's not by accident. This facility is engineered to double the production capacity of their next-generation Pelican satellite fleet.
Right. By physically locating this production within Germany, they are directly positioning themselves to capture sovereign demand from NATO allies.
Because European nations operate under strict defense procurement guidelines, and they are rapidly accelerating their intelligence spending right now.
Establishing a domestic manufacturing presence on the continent dramatically lowers those bureaucratic barriers.
It effectively makes Planet Labs the default, trusted partner for European defense ministries.
It really does. So the fundamental narrative is exceptionally strong here. You've got a newly profitable company with a $900 million backlog, an unreplicable AI training dataset powered by Nvidia, and strategic European expansion.
It sounds perfect, but we must evaluate how Wall Street is currently pricing this transformation. Let's talk about the technical chart because it recently underwent a violent upside re-rating.
It really did. On March 20, 2026, the equity surged 25.5% in a single trading session,
25% in one day.
establishing an all-time high of $33.83.
And the critical metric in that breakout is the trading volume, right? Because a stock surging on low volume can often just be retail speculation or a temporary short squeeze.
Exactly. But a 25% surge on massive volume immediately following a fundamental earnings beat that clearly signals institutional accumulation.
It indicates that major mutual funds and quantitative hedge funds have recognized the shift from that capital-heavy hardware model to the high-margin SaaS model.
And they are aggressively rotating capital into the stock to get exposure to that transformation.
Right. And if you contextualize that performance, it reveals the sheer scale of the momentum. In early 2026, the stock was up 71.5% year to date.
Drastically outperforming its industrial peers.
Yeah, and if you zoom out further, it has quadrupled in value from its summer 2025 lows, where it was languishing under $7 a share.
Yet despite this massive run, Wall Street analysts remain sharply divided.
Oh, extremely divided.
Needham recently raised their price target to $40, maintaining a buyer rating.
Right.
Conversely, Goldman Sachs maintains a neutral rating with a price target of $18.
Which is roughly half of current trading levels.
Yeah. This severe divergence indicates that traditional Wall Street valuation models are really struggling to accurately price the speed of this SaaS transformation.
And that analytical divergence leads us directly into the bear case, which centers entirely on valuation risk.
Right. Currently, the stock trades at an incredibly stretched multiple of 27 times forward sales.
And notice that is 27 times top-line revenue, not earnings.
Not earnings. In a normalized macroeconomic environment, a multiple that high firmly places the stock in nosebleed territory.
It means the market has already priced in years of flawless execution.
Flawless. If they experience, a slight delay in the rollout of the Nvidia AI platform.
Or if the conversion of that backlog into recognized revenue slows down by even a single quarter.
The stock price faces the risk of severe multiple compression.
Which forces us to ask the crucial wealth-building question for you listening. If the stock has already rallied 400% and it commands a 27 times sales premium, hasn't the retail investor arrived at this party far too late?
Well, if the strategy is a short-term swing trade to capture momentum, then yes, the entry point carries significant risk right now.
Right.
However, framing the target horizon correctly completely changes the thesis. From a fundamental perspective, this represents an 8 out of 10 bullish setup, but strictly defined as a multi-year hold.
Okay, so what's the timeline?
An investor must approach this with a firm 2 to 3 year time horizon. It will physically take 2 to 3 years for the company to fully deploy the AI software architecture across their client base.
And convert that $900 million backlog into recognized high-margin revenue.
Exactly. The timeline is dictated by the operational reality of scaling software over a hardware foundation.
Because as the high-margin SaaS revenue becomes a larger percentage of their overall mix, their profit margins will expand dramatically.
And that mathematical margin expansion is what will ultimately justify and potentially contract that 27 times sales multiple down to earth.
Got it. So an investor has to be willing to absorb the inevitable volatility around quarterly earnings reports.
Right, and trust the deep structural visibility that the sovereign defense backlog provides.
The underlying growth case remains firmly intact, provided management actually executes their AI integration and that European manufacturing capacity expansion without critical delays.
Exactly.
So, we have analyzed the financial inflection point, the physical and data-driven moats, the computational shift driven by Nvidia, and the technical realities of this pretty stretched valuation.
We've covered a lot of ground.
We have. But to close, there is one final, highly relevant macroeconomic scenario I want you to evaluate. Planet Labs has successfully built an unreplicable planetary intelligence data monopoly.
Truly unreplicable.
They possess the hardware to scan the globe daily, the decade-long historical baseline, and the AI infrastructure to extract instant strategic answers from that data. And the company currently commands a market capitalization of roughly $11.5 billion.
Right.
As global defense spending structurally increases and proprietary AI training data becomes literally the most fiercely contested resource in the tech sector, the calculus for larger players changes.
Oh, absolutely.
So you have to consider how long will it be until a massive aerospace prime contractor or a hyperscale technology giant looking to dominate geospatial AI determines that it is vastly more efficient to simply acquire Planet Labs outright for $15 or $20 billion.
Rather than attempting to spend a decade and countless billions trying to replicate their archive from scratch.
Exactly. When a company owns the baseline data that the entire global intelligence and commercial apparatus requires, they inevitably become a prime acquisition target.
Something to keep a very close eye on.
Definitely. Thank you so much for joining us for this analysis. We hope this helps you navigate your wealth building journey. Make sure to tune in tomorrow for your next daily stock analysis and catalyst talk. See you then.